What we're going to be looking at here is debt restructuring, but a modification of terms of a loan here. And we're going to be looking at it from the perspective of a creditor here, where they're going to have to calculate a new effective interest rate here, and they're also going to have a loss. And we're going to be looking at the interest revenue here on this restructuring of a loan, or it's going to be a notes receivable here. And for example, here on 12/31/20X1, Bank B enters into a debt restructuring agreement with Corporation A, which is experiencing financial difficulties here, and Bank B restructures $1 million loan receivable issued at par, and the interest is paid to date. And the note here is restructured by number one here, reducing the principal obligation from $1 million here to $900,000. And the note has 4 years remaining here, and the maturity date here is 12/31/20X5. And they're going to be paying, Bank B here is going to require Corporation A here to continue paying at the interest rate here stated on the note here of 12%. Now, the current market interest rate for a loan of this nature here is 14%, but Bank B is just going to say, okay, you have to pay here at a 12% interest rate on this loan. Okay, and then the fourth point here is that you're going to pay only the third and fourth year of interest payments at that 12% interest rate. That is, Corporation A is only going to have to pay year 3 and year 4 here on this loan for the interest payments. And that is, the first 2 years here, first year and the second year, are not going to be required. Corporation A isn't going to have to pay Bank B any interest payments here for the first 2 years. Just the third and the fourth year here. Okay, so let's go up and let's look at it from the perspective here of Bank B, the creditor here. And we're going to be looking at a loss here in the restructuring of this debt or this notes receivable, and look at how we make this calculation here. And in this example, again, remember the principal here is reduced from $1 million to $900,000, and it's going to be, we're going to continue using the stated rate of interest on this loan here of 12%. Even though the market rate is 14%, we're going to go back to this stated rate of interest, because that's what's required per the agreement here. Plus, if you're doing an example here, you always go back to your original interest rate here, or the historical interest rate. In this case, it's 12%, and then it's stated here on the terms of that restructured loan. And our interest payments are restructured here, where only $900,000 is due on the principal amount here at the 12% interest rate. So interest payments will be $108,000 per year here. Okay, here is where we're going to be using the stated interest rate here at 12%, and we have to determine the present value of this note. And the reason we're going to do that here is we have to determine what the loss is on this restructuring of this notes receivable per this agreement here, and we're going to be looking at it from Bank B, the creditor's perspective. So we start here with the pre-structured carrying amount. That was $1 million. It's being reduced to $900,000, but we look at it from the terms here of the original carrying amount here of $1 million. Now, what we have to do is we have to determine the present value of the restructured cash flows. And this is where this year 2 and the forgiveness of interest here for years 1 and 2 is going to come into play here. So first off, we have to look at the present value of that $900,000 of principal that has to be due here in 4 years. And that's at, again, we're using our 12% stated rate of interest here in a note that's agreed on. So I'm using the Excel function here, but use your financial calculator or the Excel here to figure out your present value. So again, we're using that 12% interest rate, 4 years, and discounting the $900,000 principal back. That's worth $571,966. It's present value. Now, this is where we have to determine those interest, what actually is due on these interest payments. So first off, we look at the present value of the interest payments at $108,000 per year here, and we look at years 1 through 4. There's 4 years required here. So we discount those 4 payments back here at 12%, and they're worth $328,034. Now, this is where the forgiveness of interest here for years 1 and 2. Bank B isn't going to receive any interest here on this note here per the agreement here for years 1 and 2. So this is where we have to subtract out the present value of those first 2 years of the payments here. So what we would do, again, the present value for 2 years here at 12%, those $108,000 interest payments, they're worth $182,526. So now we have to look at what is actually the present value of this total cash flow? So we take our present value of our principal amount here, $571,000, plus the 4 years here of interest at $328,034, but we have to subtract out those first 2 years here. That's the important point here. So we subtract out $182,526 from our net amount up here, and we're going to come up with the present value here of these the cash flows at $717,474. Now, a loss on restructuring. The present value here, $717,474. Subtract that here from the pre-structured carrying amount of $1 million. You're going to get a loss here on restructuring of $282,526. Now this is what Bank B is going to record as a bad debt expense. Okay, so we've got our present value of our cash flows here. Now we have to set up a new amortization schedule based on this restructuring here. So what we know here now is this. We've started out with our beginning balance here, the present value of those cash flows at $717,000 here, $474, and we have to amortize it up to $900,000 here. Now that's the maturity here of the restructured note here. It was $1 million, now it's reduced here to $900,000. So this is what we have to amortize up here. So the other thing we know here is our cash payments here. We have 4 payments here at 12% per year. That was those $108,000 cash payments. That's going to be receipts here, a cash receipts here the bank is going to receive. We got 4 of those. Now this is where we have to determine the effective interest rate here to amortize this note, or this note's receivable. And this is where you have to use your financial calculators or some means here to calculate this effective interest rate. So this is the other important point we note here. So we take our financial calculator here. We got 4 periods here. We got 4 years here, and I'm just designating these are the keys that you'd be entering these numbers in on your calculator. And what we have to do is determine this effective interest rate here with the calculator. So our present value, okay, we got our 4 periods here, and then as a plus amount here we put our present value. That's up here, $717,474. Then put in as a negative amount here your payment amount. Okay, we've got $108,000 a year payment here, and then the future value here, $900,000, again as a negative amount in your calculator. That's what the maturity value here. Then you hit your interest key, then you come up with the effective interest rate here. And you can see it, I've carried it out here to 5 decimal points. It's going to come out to the effective interest rate here is 19.80531%. You can see this is the only way you're going to figure it out here is using, in this case, the financial calculator here. So that's where this is effectively the interest that they're going to receive here on this restructured loan here. And this is what they're going to have to realize here on their income statement. So again, using your effective interest rate here to amortize it, you start out with your balance here, $717,474, times that effective interest rate here, 19 point, and those decimal points here. Take that times the beginning balance, and you're going to get the interest expense here for the first year here, $142,098. Compare that to your cash payment of $108,000, and this is what you're going to amortize here. The difference between those here is $34,098. So you add that to your beginning balance here, you come up with your new balance here, $751,572. And just proceed on down here, taking your beginning, your new balance here times that effective interest rate is going to give your interest here for the period. Compare that to your cash payment, and that's the amount, and the difference here gives you the amount of amortization here for that period. And just carry it on through until you get down to your amortized amount here of $900,000. So just looking at our total cash payments, we had $432,000 here cash payments, and then effectively we would have received $614,526, and then our amortization here was total amount here $182,526 here. That's simply the difference between our beginning balance here and our maturity value here. And then the amortization here is really the difference between your effective interest rate, interest that you have on this loan here, and your actual cash payments gives you the total amortization here. Okay, so remember here, just use once you determine your present value of those cash flows here, and remember that you have to, in the case here where you got those years that aren't included here, you have to discount those back here and balance them or subtract them out here from the total number of years. We could go back up and look at that, but just remember you have to calculate your total interest on that loan that you're receiving based on the payment reductions here. And then also the value of the maturity value has to be known here. In this case we have it, and then we had our cash payments here. And then effective interest rate, you had to use that calculator, putting these numbers in. Your present value here, up here, that's what you calculated here as what your present value of those cash flows, and then you knew your payments here, and then the future value, and then you could determine your effective interest rate. So that's what you want to take away from here. Now let's go and let's just look briefly here at how we'd enter this on our balance sheet and our income statement. Again, this is Bank B, the creditor, and we're going to be looking at the bad debt expense here and the interest revenue after restructuring this loan. So just looking at first, we got our cash account here, and then our notes on our asset account here, and then we have a notes receivable here. That's also an asset, and we're going to look at this is the restructured debt. And now what you have to set up here as a contra account to your notes receivable is an allowance for doubtful accounts. That's a contra receivable account here. That reduces your notes receivable here. And then we're going to also have our bad debt expense here and our interest revenue here. So let's just go through these accounts one by one here. So we had our accounts receivable at $1 million here. So we would have debited that here for $1 million at the beginning whenever that note was issued. So that was sitting here. So now what we have to do here is look at the restructuring date here at 12/31/X1. What you would do here for that restructured amount here, that was that $282,526. That was the difference between the present value of the restructured principal and the net here against those interest payments against the $1 million that was original in the note here. The present value of those cash flows, subtracting those from the $1 million amount, original amount here. That's going to give you your actually that's what we calculated as the bad debt expense here. So you set that up as a credit here in your allowance to doubtful accounts here for $282,526. That reduces your accounts receivable, and then over on your income statement here you would recognize it as bad debt expense. Again, at that restructuring date here, debit that here for $282,526. So you got your credit here in your allowance for doubtful accounts, and then you got your debit here in your bad debt expense here on your income statement. Okay, and then off of your amortization table here, well, first off with our cash account, we would have increased that by those cash payments, $108,000 each year here for those over those 4 years here. That was $900,000 times 12%. And then over in this allowance account, our doubtful accounts, that is where we amortize our carrying value here from $717,474 up to the maturity value here of $900,000. That comes off your amortization schedule here, those amounts here from years 1 through 4 here. Okay, and then when we get the balance at the end here, we got to $100,000. From $282,526 to $100,000. And then as our interest expense, that also came off our amortization schedule here. That was that effective interest rate that was at 19.80 here. Is that 19.8 some percent here? That was the effective interest rate for each of those years here that we calculated. That comes off our amortization schedule. Okay, so we've taken care of our interest revenue here. We've got our allowance for doubtful accounts here that we have to amortize down, and we had our bad debt expense here at the restructuring date that we recognize that. So at the date here that this note actually comes due, and we're going to Bank B is going to receive the cash here, we would have $100,000 in our allowance account here. We would have taken our credit amount here, debited that out here for $100,000. And then for our cash account, we would have received $900,000 here, that new agreed on maturity value here for debit our cash account for $900,000. And then our notes receivable here on our balance sheet, we had it sitting at $1 million here, and then at the maturity here, we would have reduced that or taken that off the books here by $1 million. So our credit here of $1 million balances with our debit here of $100,000 on our allowance for doubtful accounts, and also our debit here in our cash account here for $900,000. Okay, so what we want to take away from this here is that we had to come up with a new effective interest rate here to amortize realize what interest revenue we're actually realizing on this note here, and that was on our income statement here based on that new effective interest rate based on our restructuring on a loan here. And then we had to recognize our allowance for doubtful accounts here, and those amounts here had to be amortized here over the 4 years here off our amortization schedule here. And then remember here, our allowance for doubtful accounts, the credit amount here had to balance with our bad debt expense here on our income statement when at the date here that we restructured that loan. Okay, so that takes care of this debt restructuring here for this loan where we modified the terms, and this is where our creditor, looking at it from the creditor's perspective or Bank B's perspective here, where they had to come up with that new effective interest rate here and determine the interest revenue off that, and also they had to determine the bad debt. In this case, there was a bad debt that had to be realized here on this loan, on this restructuring amount.